The calendar changed? Seems like everything changed.
It's a lot different.
How have you changed your plan, or have you?
Yeah, we absolutely have. We obviously noticed the uptick in volatility around the geopolitical events in Ukraine. And so we did lighten up on risk a little bit in the portfolio, which has really paid dividends. I mean, the idea there was, hey, things are still fundamentally strong in the U.S. economy. Risks are ticking up, though. Probably would make sense to put a little on the side. And so we've done a bit of that in the portfolio.
Okay, are you trimming U.S. equities, or are you buying more on the weakness here? Because you're a giant super tanker, $204 billion.
Yeah, absolutely.
You move slowly, but when you move markets.
For sure, and we do, and that's something we're actually very mindful of. In fact, when we rebalance, we were very mindful of how those flows might affect the market. But yeah, we are underweight U.S. equity at this point in time. Marginally so. We're never going to take very large bets, but we are definitely underweight this time.
But for you to say even on the margin you're underweight equties, Jase, and you're being modest, but that's a powerful statement. I mean,
yeah, exactly. 1% would be a $2 billion. Would be it would.
$2 billion bucks. I mean, that's a big change.
Yes, absolutely, for sure.
What is it that you saw that made you nervous, or less confident, or whatever term you want to use?
Yeah, what we really saw make us nervous is capped upside. So we've been talking about the Fed put for a very long time. We're thinking now there's actually a Fed call on equity markets because the Fed needs to move. They need to move rates up.
Yep.
And so as long as the equity markets aren't falling, it's easier for them to do that. And if they're going up and up and up, they can continue to raise and effectively put a cap on the equity market. So
you think the U.S. equity market will end the year down this year? I mean, it's going to be pretty hard to not
reverse where we are now, right? Because the S&P 500 down 11 or so, Nasdaq down 20 or so.
Which means you got to gain back 25, 28% to get back to zero.
Correct. We don't think there'll be a recession this year. That would be the largest impact that would cause that to occur. I mean, the one thing that you would ever want to know as an investor is when is the recession going to happen. If you knew that, you would know the answer to that question.
Who's going to win this year's Kentucky Derby? I'd like to know that ahead of time too, right?
For sure.
What's the winning Powerball number?
Yeah.
If you trim by 1% in U.S. equities, what are you doing with that money?
We hold in cash, for sure. Yeah.
But inflation eats cash.
It does, but that opportunity cost is still better than if you're holding it in something that goes down. And so we just prefer not to do that.
This is really important what you're saying. Let's call it negative 3% return on cash. Okay, assuming the 10 years at 3, real inflation, negative 6, whatever you want to call it. I don't know if I've ever heard anybody in your position in a long time say, I'll take negative 5 or 6%. Because that may be all I'm going to get. And that's the best, worst case scenario.
Yeah, I mean,
you sound really bearish.
Yeah, I don't mean to sound so bearish. It is at the margins. The underlying consumer is still very strong. The U.S. economy is strong.
But the market is doing something different.
It's really kind of
telling a different story.
Exactly. We're facing the headwinds of the Fed. Everything fundamentally says that we're still mid-cycle. Mid-cycle is a very good place to be for risk assets such as equities, those sorts of things. But the Fed's two mandates, inflation and unemployment, are both just flashing late cycle. So you have just a very strange dynamic where the underlying economy is doing well, the consumer is doing well, consumer confidence is there, and yet obviously the Fed is going to move and everyone's anticipating.